Welcome to the Master's Certificate in Technical Analysis. This video is for Module 17. This module is concerned with contracts for difference and spread betting. Spread betting is very similar financial instrument to contracts for difference, but it's used mainly in the UK because of the tax advantages of not being taxed on the betting winnings in the UK. But I'm dealing with them both together because they're so familiar, and also in this module we'll be talking about trading principles. First, CFDs, the advantage that you get from these derivatives. They are a leveraged financial product. Contracts for difference are purely a contract between two people that says we'll pay you what the difference between the prices of this product is when you close the trade. So you may have a contract for difference on share prices. If the share price goes up and you're long on the contract for difference, you'll get there as much as they go up. It'll cost you probably about 10% of the price of actually buying the shares, but you can equally well go short on contracts for difference, and again that's an advantage you have over people just buying the shares, whereas you're just someone who can borrow shares to sell. Contracts for difference is just straightforward. You go long or short as you want, and your leverage to be 10% can be as little as 1% that you pay for the contract for the difference on indices, and you can do it on many different financial products. They only really got invented in the 1990s, but they are a terrific trading vehicle. You just have to watch, as always, with the leverage product. If the trade goes against you, you can lose more than your stake, and you can margin call out to make up to so the broker doesn't get caught holding a debt. I would say available are many underliers, typically indices from around the world. You can get them on the S&P 500 or the Dow Jones. You can get them on the DAX, virtually on anything around the world, as well as on stocks in the different markets. You can have stocks in the US and the UK markets. CFDs in spread betting don't happen in the US because the SEC doesn't like them very much. But in Australia and the UK, the CFDs are big as well as spread betting. But they do allow you to do trading on international stocks and on different markets, and you can usually do it with one or two brokers when you use CFDs. Tax and stamp duty advantages. Stamp duty is payable in the UK when you buy shares as well as when you're buying houses, and of course you're not buying shares in CFDs, you're taking a position on them, so therefore you don't have to pay any stamp duty, another advantage compared to normal trading. And when we talk about derivatives, you think of futures, but the CFDs are better than futures in the sense that margins are usually better. You have to pay less, and also on the futures you're sometimes stuck on a rather large lot size, and you can get away with smaller lot sizes on CFDs. So they have advantages over that way too. Types of CFDs, virtually anything you can think of. Any financial instrument can be traded with a CFD. Check with your broker and you'll certainly have a big range of things that you can trade, and you can see the first one we've got is commodities. Commodities are frequently associated with futures contract, and CFDs are quite often traded on the futures contract. So you're trading a difference between a futures contract in this week and next week. So instead of taking out a futures contract, you do a CFD. You pay a bit less margin and you can do a different amount. With gold it can be a spot price. You can take gold at spot price like 10 or 100 ounces of gold, and typically about at 3% margin they can be on a futures contract. So again, check with your broker, and it's a very flexible financial instrument. Of course, under commodities you can trade a lot of different commodities. I've just picked out a few here. Oil is one that's very popular because it's volatile, and also because it's the trader's favourite. If you enjoy the volatility and the challenge, you can get CFDs on oil. Typically you can trade on 100 barrels of oil with a 3% margin. And gas is usually traded on gas futures, and you can trade on the gas or the crude oil on the American markets, and that's just the same. Some of the commodities you can trade on. You can trade on most commodities in CFDs. One that is trading is on indices, and again the margin on these is perhaps 1 to 3%, so it's very easy to trade. Easy trading. Also, you can get caught very easily too. You have to watch the prices going up and down so that you don't get stuck too much with margin calls and losing your account, as with all derivatives. So you just have to make sure that you're still applying sensible trading practices, and with indices you don't usually pay any commission at all. If there's any commission on the CFD, it's typically about 0.1% of the underlying value. But with indices, normally the broker's money is just made on the spread between the buying and selling price. Another popular thing to trade with CFDs is the sectors. You can trade on the healthcare sector, the energy sector, whatever you think you can trade on going up or down. Another thing to watch with sectors is that the spread is normally a little bit larger than is normally applied on the stocks. If it's a sector, maybe the telecoms, where you have a couple of large companies that dominate the sector, you may find that they're a bit cheaper. But if it works out better, if you do a couple of CFDs on the individual stocks rather than going into the sector, where you have a bigger spread than you have to make up before you go into profit. And then the other thing to mention is stocks. Typically you can do CFDs on the stocks in many markets. If you're interested in doing American stocks, you'll also find CFDs in those. And a couple of newer ones just to mention. You can get CFDs on inflation now. This is the Consumer Price Index, CPI in the UK, and I forgot the acronym, and it's also the European rate of inflation. You can get the trade CFDs on those. And it's important to note that they take inflation figure as first published, not the adjustment. So you can settle a CFD for profit or loss straight away when the CPI is used. Inflation, the company doing that will sell your CFD on inflation. And carbon trading is another popular thing. Carbon trading is selling at about 13 euros at the time, from around the end of 2009. It's varied between an 8 and 30 euros per tonne. So it's a very volatile market. So good luck if you want to trade this one. It's one where I'm not sure there's a lot of conventional wisdom because it's such a recent invention. So you just have to look at the charts and figure out which way the trade's going to go. This is traded by a minimum of 25 tons, I think with about 10% margin. Still very reasonable to trade, and you can trade on the price of carbon trading. So types of CFDs that cover them. Again, you have to refer to your broker to see exactly what is available, but they basically write financial instruments on anything anyone wants, and you'll find the range of things you can do with CFDs is increasing. So it's a very popular thing. You can leverage your money as much as you want. Again, you have to keep your money in proportion. If you don't know what you want, and it's much more convenient really than being involved in separate markets for brokers. Now we'll just take a moment, as this is the end of the last training video, we'll take a moment to look at the principles of trading and just go over the outlines of what we're looking at. Firstly, we'll want to look at the market. I say it because the best advice is to trade with the trend. You can trade counter trend and even get away with that, and people even make a profit at it. But what we want to do is basically trade is to lower our risk, and if you're trading with the trend, you're basically lowering your risk on the trades in general. The market may be going up, or it may be going downwards, or it can be going sideways, so you want to see where the market is going before you decide where you're going. Basically figure that you're going to be trading long. If it's an uptrending market, you're going to be trading short if it's a downtrending market, and if you're going to be doing anything more clever than that, then it's a sideways market. That doesn't mean you'll only do long if it's an uptrending market, but you'll find you're doing a majority of wrong trades and you're probably keeping the risk level too high. And that's what it's all about. It's just a percentage game. And you're probably just going with the odds, and you must simply get is that you don't have to be in the market all the time. Sometimes it's really a good thing to be out of the market so you don't force the opportunities. Look for opportunities, and if you don't, and if you could take them. But if you force opportunities, they may only well be half good, and you may be increasing your risk there. That's not a good thing. Play with the odds. Know your loss level. Basically, you need to know how much you can afford to lose if things go against you. I suggested in this series that 2% of your account is a reasonable loss level to aim for any particular trade. Some people say 1%. That doesn't sound like much. Remember that you're generally talking about losing all your money. Instead, it depends on what financial instrument you're using. Whenever you're generally talking about them in stocks and shares, you're just generally talking about them dipping down to a certain level where you're, say, it's gone down more than enough after you're only losing what price it goes down to. It's always worth figuring this out. Making a spreadsheet, certainly you don't want to be losing more than 2% of your account at any one trade, and if this happens, you'll find that you won't be able to trade because you'll run out of capital too soon. So that's one principle: you should know your loss level. In conjunction with that, you should know when you're wrong. Know at what level you're going to say it's not going my way, and I guess my estimate was wrong, and you're going to get out fast to cut your losses. If you know when you're wrong, you don't have to wait longer to prove to yourself twice over that you're wrong. When you know you're wrong, you get out. And in conjunction with that, know your expected profit. This is because there's no point in trading something where you stand to gain $5, but the odds against you is $10. Certainly the odds have to be in your favor. The other way you want to have a reward is to have a risk-reward ratio of 3 to 1. So if you can, some people use 2 to 1, and that's okay, but 3 to 1 is better. So you want to see that your profit could be at least 3 times as much as your loss point. Having said that, all trading is not necessarily about concentrating on profit. You'll find that a lot of people who start trading and concentrate on profit don't last very long. Trading is conserving your capital. It's about being in a trade by 6 years, by being in trade by 6 years' time and still trading rather than having lost it all. So if you concentrate on conserving your capital, you use good trading strategies, and you'll find the profits will come. Conserving your capital is the most important thing, otherwise everything you've learned will be pretty much useless. Also, as a final note here, keeping a journal. This is a very good thing to do. You need to get your feedback along with training and ongoing education. You need this to see how you're doing. Do your trade in the morning and then in the afternoon if there's a question, or do you find that you're in all your short positions play out on your long positions? Every trader is different, and if you keep an account of where you're going with your trading, you'll learn and you'll see how the opportunities have occurred, and you'll look more carefully at the opportunities that don't seem to work out as well. The journal, it has a lot of things in there, like the date and the time. Sometimes people tend to get sluggish after lunch, so they may not trade so well. So you put in a date and time, what you're trading, whether you're going long or short, and why you picked that, and what other things came into alignment that made you say that it was a good trade. For instance, you saw a candle pattern, an oscillator signal, whatever. Write down your reasons. And how strongly do you think this trade should be taken? What was it that made you not miss this opportunity? What is I should not miss this opportunity? Or what am I getting bored this afternoon? Looks good enough, maybe I should take it up. So you can grade it from 1 to 5, 5 being really I want to take it, and 1 being, well, I'm feeling boring today. I'd advise that if you can put some indication of how strongly you feel about the trade, and then also maybe how you'll get some assistance. Part of the trade is putting in your profit target. Where do you think it's going up, and what your loss level? Write it down, because that's good. When you're in the trade, emotions get involved, and when you've got it written down in your trading journal, it will help reinforce your decisions from getting out without continuing in the loss. Another thing to write is how long you're in the trade and how long you intend to trade with your short-term day trader. If you're a short-term trade trader, maybe you could have been a day trader, or for a couple of weeks it's not doing anything, so maybe you could have done something better with the money. So instead of the trade you hang on to too long, you could say after 3 days, hey, I need to get out of this because it hasn't taken off. That's something you can say by looking at your journal. Okay, on to the general trading strategies. These are just general principles that you've got to form your own trading plan and write it down, but these are just some general ideas. If you're in an uptrend, you need to know an uptrend goes up in a series of waves and retraces of maybe 38, 50 or 62% of the Fibonacci ratios. So you know how much in ratio for which you're going to see an expected uptrend. So you go through whatever indicators you're using. Maybe you're using long-term moving average to see that it's a good solid uptrend. But you'd also look for the dips in which you would see some successive lows. But this is a good strong uptrend. It is a good uptrend, but this is a retracement. You may want to look and see where this is going to turn and where this is a sign of turning around you buy. When you see that sign, when you see successive highs and it's going back into the uptrend, this isn't a risk to find a probable trend. This is just bread and butter in trading. A similar one in an uptrend, buy relative strength. Maybe you don't look for a dip, but you look for the best of the best. You look for an uptrending market, you look for an uptrending sector, you look for the best shares in that sector and you go long. And you have a way of exiting when it starts to falter. But you're basically joining in. It's basically like jumping on a train next to the running on the track. Doesn't mean the train's going to go anywhere just because you're a bit late in getting on it. Unless you're psychic, you're probably not going to get in at the bottom when you think. So don't even fret about trying to get in at the bottom. That's a high-risk strategy. You must jump onto the train that's already rolling on the track. And the opposite of that is the downtrend. You're selling rallies and you're selling relative weakness. And downtrend is relatively interesting because shares are kind of dropping under their own weight. So if you're doing short on shares, if you're going short on shares, you can score more quickly than you can score more profits. So it's not quite that one thing is opposite to the other thing. If you happen to get into a downtrend and you read that right and you go short on the downtrend, you'll find that maybe you're making the profits more quickly. Again, you do the same thing. You look at the moving averages, you look at overbought, oversold, and choose your time to get into the market. The final strategy is just when the shares are going sideways. If it's going quite literally clearly sideways and the market is showing quite strong supports and resistance levels, it hits a couple of times for you to think that it's a support and resistance. And yes, certainly these are short-term trades. Follow on up and just wait for things to draw down. You know the price is going to balance between support and resistance, so you've got to keep trading one way or the other. Long up to resistance, short back down to support. It's good if you've got sideways market. This is because you can find straight away if there's a breakout. You can set your protective stock just outside the support and resistance. And you'll know straight away if there is a breakout. You're thinking you'll see the starting of a trend rather than sideways continuation. So those are the basic principles. You find your own method of determining what is an uptrend, what is a downtrend, what is a weakness, overbought, oversold. You find the ones that work for you and back test them. Those are the obvious ways of trading for profits while keeping your risks down. This is the end of the videos. Basically, you're still at the beginning of your trading career. Quite possibly, so certainly we're here for your support and for your information. And there'll always be questions that will come along, so that's obviously all part of the Master's Certificate in Technical Analysis course. We'll be here to answer your questions and to explain anything that isn't clear to you. So we'll look forward to hearing from you, and goodbye for now.